So consumer confidence is where I want to start at. The reason why we have seen a lot of slowness in the real estate market is that consumers just are not feeling very confident about the overall economy. And if you take a look at the University of Michigan Consumer Sentiment Index, you can see that on the left-hand side, it's near a 20-year low. There's actually a little bit more history than is illustrated on this. And if you ask them about how do you feel about the current economic conditions, it's also at a very similar level. We think this is a function of a number of things. The concerns about tariffs raising prices because grocery store prices have gone up. There's a lot of headlines about large companies laying people off. Certainly the interest rates, while they have improved a little bit, they're historically a little bit on the high side. And I think there's just a general sense of unease about AI, making it more difficult for people to find jobs. Collectively, all this is fed into a lot of negative sentiment. So specifically, we found within the University of Michigan survey, there's two questions about, is this a good time for you to sell a house? Is it a good time to buy a house? And you can see on the right-hand side for, is it a good time to buy? We're nearly at record lows, just a little bit above. So what'll probably need to happen here is we need to get some resolution about these tariffs and get that out of the headlines all the time. Resolving the tariff situation will probably get us a long ways towards resolving some of the inflation that we're currently experiencing. And it's anticipated that the Federal Reserve is going to have a couple more price cuts. In composite, those things will probably get us towards a more positive outlook on the part of consumers, and that'll lead to more real estate transactions. Checking for questions, none, fantastic. So should the consumers be as bummed out as they are? And the answer is probably not. So the target for the inflation rate is 2%, and you can see that we're floating around 3%. So a little higher than expectations, but not dramatically so. Unemployment, right around 4%. So you can see it's increased at a very gradual rate since 22, but nothing at all that's completely out of hand or anything like that. Now, the number of new jobs being added, as you can see on the left, has been declining, but that hasn't really translated to an increase in unemployment yet. So far, so good there. Hopefully that'll continue to be the case. We are a little worried that job layoffs, at least as announced by large companies, has been increasing lately. But, to have, 1 million layoffs year to date on a global economy here in America that's got, 150 million jobs, it's less than 1%. So the net of all this is that if you ask just the typical citizen, about 2/3 think that we're going to have a recession in the next year. If you ask economists, it's about a quarter. So the economists think that we're going to have a relatively slow growth year next year, around 2% expansion in the economy. But the consumers are a little bit more bummed out than that. And that's a large part of our consumer confidence numbers being so bad. And there's our estimates from the economists. 25-30% think we'll have a recession in the next year. So another headwind that we're seeing getting buyers into the market is the first-time buyer market segment is a lot slower than normal. And that's a function of a couple things. The first is affordability, with the mortgage rates being a little bit higher, makes it a challenge for people to be able to qualify. A number of other factors are around delinquencies and debt, particularly for student loans. A lot of the newer younger consumers are having a tough time staying current on all of their debt, including their student loans. Makes it really hard for them to save up the money for a down payment on a house. And that's just a headwind I think we're going to have for the foreseeable future, most likely.
I think we're going to have that for a long time. That student loans really makes a big impact.
Yeah, no doubt about that. Thanks for logging in, Joe. I'm glad that you're here. Are you seeing this on more of your mortgage applications recently?
So personally, no. I don't see a lot of people with delinquent student debt, but I see a lot of people with higher balances. And now those have come out of forbearance and they're into repayment. And I mean, gosh, I bet I see people with $500, $700, $1,000 a month in student loan repayment.
Wow.
And that impacts their ability to qualify for a new mortgage. So delinquencies, no. And I think that's just a function of, if you're behind on your student loans, you're probably not thinking about buying a home. So I don't think those folks filter over to applying with me. But I do see a lot of people that are current on their student loans, but have really high balances and really high payments. And that compresses the ability of what they can qualify for. on a new home mortgage, thus compresses the price range that they can look at.
So the overall pool of potential first-time buyers is being compressed, at least partially because of the student loan balances. And there may not be like any near-term solution to get these people into the buyer pool, though. They might be stuck being renters for quite a while.
Yeah, I think that's true. And, we could go down or I guess I could go down a dark rabbit hole of, student loan debt's not for everybody. There's a lot of great trades jobs, electricians and plumbers and car mechanics that you don't have to go to college for. But I think a lot of folks are seeing, man, I've got this 100, 150, 80,000, whatever number of student loan debt, and it might not have been a good investment if they're not able to outrun it with, a higher paying job.
There was an interesting article in the Wall Street Journal this morning. The CEO of Ford Motor Company was bemoaning the fact, I couldn't remember the number, it may have been 4,000 or 5,000 job openings across all of Ford Motor for people who with strong mechanical skills. And these are jobs that pay in the low six figures. I think it's like $120,000 is what was quoted in the article. And they can't fill the jobs because there's not enough people coming out of the trade schools with the right skill set. Interestingly, about 100,000 new graduates from trade schools in the last year versus like 1.4 million new college graduates. A lot of people with degrees that don't immediately translate into something that you can get a job with. So we need more electricians and mechanics.
Yeah, we really do. And those are good paying jobs. I went to college, you went to college. I'm never going to tell somebody don't go to college. I love higher education, but sometimes there might be better opportunities when you don't have a lot of student loan debt.
Absolutely. No doubt about that. So the age on average of a first-time buyer has zoomed from around 30 years old, where it was for a very long period of time, decades and decades, to now it's closer to 40. And the median age of a home buyer now is a little bit over 60, if you could believe that. So a large component of the first-time buyer pool has been priced out. So for those of you on the call who are investors, this means that people who are renters are likely to stay renters for longer, and the amount of renters is probably going to grow, and the number of homeowners is probably going to shrink a little bit. So it'll be a transfer of wealth across the whole country from a large number of people who can no longer be a buyer to the landlords who own those rental properties.
Yeah. And this I do truly see. The average age of my first-time buyer is right in line with that 38, 39, sometimes 40 years old, and they're buying a home for the first time.
Yep. So if you guys have any questions, feel free to drop into that chat box, and either Joe, can you see that as we're going through here?
Yeah, I can see. And actually, Michael did just ask, the average age is 60. Can we clarify that a bit? So not comparing first-time buyers, but all buyers.
Yeah, the composite of all buyers is around 60, which is also going up quite a bit. And that's really just a function because the people in their 20s and 30s are like gone. And now, 40 is like the new first-time buyer age. And so it's really skewed to an older demographic.
Yeah. And one thing I would add is the folks that are in their 20s and 30s that are buying, I'm seeing upwards of 50% of those getting some sort of family help. Either mom and dad are co-signing, or mom and dad are providing a gift. Gift funds for down payment are very, very common right now.
My daughter is 25 and she's an accountant, and she discovered, to my shock, that accountants in Houston make more money than accountants in Denver, despite the fact that the homes in Houston are about half the price. And a couple of years ago, she showed me what $400,000 of a house in Denver buys, which is like a dog house, and $400,000 for a house in Houston buys you a very, very nice home. So I helped her out a bit in buying her first places. I didn't want her to move to Houston, so I can definitely relate to that.
Yeah.
Frightening. So why do you want to buy real estate? Well, the people who are homeowners have an average net worth of just under $400,000, and the average net worth of a renter is around $10,000. So it's just this amazing wealth generation engine for homeowners. So even though it's like a headache to be a homeowner, it's certainly very much worth it.
I completely agree with that. I share that slide with a lot of folks that are nervous when they're in their 20s or their 30s, and they're just not sure. Especially, I don't think we have a slide for it, but from a dollar per dollar standpoint on a monthly basis, sometimes right now it is actually more expensive to buy than it is to rent. But I point this out of, hey, I understand maybe it's $300 more every month to buy a home, but what is that $300 going to get you in 10 years? Would you rather have your net worth go from $5,400 to $10,400, or have your net worth go from 180 to 400,000? And so this is a really powerful chart for agents on the call. If you're talking with first-time buyers or younger folks that are just uncertain, this is a really powerful chart to share with them.
It goes a long ways to helping people visualize the opportunity.
Yeah.
So I'm going to talk briefly about the national trends. So what we're finding is that people are staying in their homes for a longer period of time. So this is per every 1,000 homes in America, how many home sales are there in the first 9 months of the year, going back to 2012 to current. And you can see that the number of homes being sold per 1,000 is declining quite a bit. So it means people are staying in their homes longer. So part of that is affordability driven, which we've talked about. Part of it is there's a lot of sellers with a 3 or 4% mortgage rate that if they sold, Joe, what's the current mortgage rate now? Like in the low sixes?
6.22.
Okay. So, I mean, to go from like 3.5 to 6.2 is a really big change in payment. So you have to be pretty motivated to want to switch. And economic uncertainty, which we've talked about quite a bit. Are you hearing this in any of your buyer interviews as they're applying for loans?
Yeah, I am, especially trade up buyers. They're thinking, man, I've got a house that's kind of small. Don't really love the kitchen, don't really love the backyard, but 3.5% rate, we're going to trade up to something $300,000 more, and our payment's going to double, maybe go up 1.5 times. When they go out and they start looking, trade up buyers, they're not that excited. They've got to be in a certain amount of pain that their current home is no longer serving their needs significantly for them to want to really trade up. So I don't see a ton of people doing what I would call an optional trade up. You've got to be in a certain amount of pain in your existing home to want to trade up right now.
Yeah, I think that's definitely true across the board. So this might be a chart you could tell us a little bit more about. So the percentage of mortgages below 3% is the orange line on the top. And you can see that it was like pretty much non-existent for a period of time, grew a lot in 2020, 21, and 22. It's getting a little smaller. And then people who are paying more than 6% has been growing recently. But what are you seeing with this, Joe? And is it impacting your refinance traffic any?
The interesting thing, we're seeing more cash out refinances, which I don't know if we have a slide this time for credit card balances. We are seeing credit card balances increase pretty significantly. And a lot of folks that have a 3.5% rate, they say, hey, I'm never moving, I'm never refinancing. Well, that's true, except for the cases where it's not true. And I'll bring your attention to the top right-hand corner of the orange section, where you see that is going up, but that's indicating that there's fewer loans below 3%. And if everybody said, hey, I've got a 2% mortgage, I'm never doing anything, that number would stay exactly the same. But it's going up, meaning that there's fewer of those loans because people are accruing credit card debt, people have to move for job changes, marriages, divorces, all sorts of different things. But it's going up at a pretty slow rate, coming back to a lot of those folks, they're not in enough pain to trade out of that. There are some people that have, again, the home is just too small, or I've got too much credit card debt, and we do need to refinance it. A good example, I've got a client right now, they have a mortgage of 3.75%, but we are helping them consolidate more than $100,000 of revolving debt, and they're going to a rate of 6.5. And so you might be sitting there saying, well, why would they go from 3.75 to 6.5? We're saving them more than $2,000 a month by eliminating revolving debt that's at a 29% interest rate. So an important factor that we always look at is what's your blended interest rate on all of your debt. So while you might have something that's really, really low, if you have a lot of other stuff that's really high, this particular client, their effective rate is more than 9%. Now their mortgage rate is really low, but when we combine all of that to a new rate of 6.5, that saves them a ton of money. So we are seeing some of that where folks have accrued other debt outside of their mortgage, and now they need to deal with it.
And then the interest they were paying on their credit cards was not tax deductible, but this larger mortgage, would that all be tax deductible?
That's correct. Yeah. In this particular instance, they're below $1 million, which I think begins to phase out tax deduction if your loan amount is greater than $1 million. And that might have changed with some new regulations. But yeah, all of that credit card debt now becomes tax deductible.
So while they're paying 6.25% or or 6.5%, by the time they take the tax credit into account, their effective interest rate might be in the high 4s. So
That's
it may
right.
not be as pricey as you think once you factor in the tax considerations to it.
That's right.
That's great. That helps a bunch. So the number of home sales, this shows you January through December, number of home sales by month for a bunch of different years. So if you take a look at pre-COVID, which is in the middle, this is what I think of as the normal, is having a run rate of about 5 to 5.5 million homes selling in a year. And for the longest time, historically, that's what it's been. If you look at the top of the chart, during the COVID boom, 2020 and 2021, we had very low interest rates, stimulated a lot of traffic. And instead of selling 5 million homes a year, we were close to 7 million homes a year, completely unsustainable. And ever since then, at the bottom of the chart is our recovery. So instead of selling 5 million homes a year, we're selling closer to 4 million homes a year. And part of that is just because we sold homes that we shouldn't have in 21 that we're not selling now. And part of that is just the ongoing affordability that we've talked about. But when we talk about having the market slow down, this gives you a magnitude of how much it's slowed down from a historical sort of a context.
Lon, can I pause you? We have a question there.
Yep.
Do you think we will have a recession in 2026? Will a wait and see strategy be rewarded versus continuing to buy real estate each year, i.e. dollar cost averaging?
Great question. So the economists think that it's only like a 25% chance of having a recession in 26. I tend to agree with that. I haven't seen any forecasts for 27. I think the odds of a recession in 27 are probably a little higher. I think somewhere in the deck, I've got a slide showing what happens to home prices during recessions. Generally speaking, home prices continue to go up at a relatively slow rate. So I would say if you are in a position where you could buy an investment property now and you find one that makes sense, it's a great opportunity for your style of ownership, I would just go ahead and do it.
I agree. And I think if I could add one thing to that, looking at this chart here, there's the concept of a rolling recession, right?
Yeah.
So a full recession means that everything in the economy is contracting at the same time. Well, a rolling recession means that certain segments of the economy contract, not in lockstep all at once, but housing contracts, and then industry contracts, and then, computer software contracts. So we're kind of in a bit of a rolling recession, and this chart really shows it, that the normal, we were selling 5 to 5.5 million homes. Now we're in a housing recession, meaning some prices have come down a little bit, but overall activity is very low, down by as much as 20% compared to normal. And so if you're an agent or you're talking with your clients and they say, boy, it just feels slow, this really represents that we're in kind of a housing recession, that there's just not as much activity going on. And I think for us as real estate investors, that's potentially a good buying opportunity, because at some point things will shift back to normal. I really agree with what you said, Lon. In the COVID boom years, we really fast forwarded a lot of those sales. And now we're kind of in that hangover that there's less sales because we fast forwarded so many of them. But for investors, it might be a good opportunity, exactly as you said. If you find something that fits your style and works for cash flow, might be a good time to buy as things go back to the normal 5 to 5.5 million transactions per year.
Interestingly, kind of to build on that, this next 6 weeks is a particularly good time for the prospective investor, because a lot of people who are residential will be pulling their homes off of the market. We usually see inventory really starts to drop about mid-November in anticipation of people don't want their home listed for sale through Thanksgiving and Christmas and New Year's. So the remaining homes that are on the market, those are people who were really motivated to sell. And a lot of them have been on the market for months and months. So if you are just hunting for a generic sort of rental, you're not looking for something special, you can just go out there and spray 10 offers with really aggressive prices. And a lot of them are going to tell you, pound sand, we don't want your low ball offer. But someone's going to come back and say, you know what, we don't like your offer, but we'll counter you at least. And you'll find the one out of the 10 that's really motivated. So don't be bashful about writing a lot of offers, particularly if it's a house that needs a little bit of work. Those tend to be very good values, especially this time of the year.
I'll give you a strategy real quick, and then we do have another question, Lon. I have one client, and I've worked with her for 15 years, and she looks at homes one day out of the year, and it's the day after Thanksgiving. And She gets pre-approved. I got her pre-approved last week, and she goes out and she looks at 5 to 10 to 15 homes the day after Thanksgiving, picks out exactly what you said, 5, 6, 7, makes offers, gets 1 or 2 under contract, closes on those before the end of the year. And her theory on that is anybody that will accept a showing the day after Thanksgiving has to sell their house.
That's right.
And that's the only day that she looks at properties. She doesn't look at properties any other 364 days of the year. And she is a real estate millionaire looking at homes 1 day out of the year.
I love it.
Now, we did have a question from Enrico, and I love this one. I'd love your answer on this. When are things going to shift back to normal?
So the first big building block is we've got to get consumer confidence more into a normal sort of a band. And I talked about, getting rid of the tariffs in the headlines, getting a little bit more rate relief from the Federal Reserve, getting through inflation concerns. Those will be things that will bring consumer confidence back to normal. I think that's going to help a lot. I do think there's a possibility that the sales annually over the next 5 years will be below the run rate that we enjoyed, say, in 2019 or 2015. I don't know we're going to get back to that new normal in the next 5 years. I think it'll be better than this year by a lot, but I don't think it'll go all the way back because I think affordability for the first-time buyers, mostly as Joe spoke about the student loan headwinds, I don't see that going away anytime soon, and that's going to limit a little bit on the buyer traffic. What do you think, Joe?
I completely agree with that. And this is an unpopular answer on this. A rate of 6.2%, that actually is normal. And our perception is kind of skewed because everybody on this call, we love the years of 2%, 3%, 4% interest rates, but a rate of 6.2 is actually pretty normal. So are we going to see some event that's going to move us back to 5 million sales a year? I don't think so. I think it's going to be a slow slog that, 2 years from now, we're going to sell 4.2 million homes. 2 years after that, we're going to sell 4.4. 2 years after that, 4.6. I don't think we're going to log on here in a year or 6 months or 2 years, and there's suddenly going to be a spike to bring us back to 5 million homes a year. I think it's going to be a long, slow slog. So Enrico, that's such a great question. I don't think there's going to be just a turning point in the market.
Agree with all that. That's probably what we're looking at. So I'll just show you this briefly. This shows you the amount of inventory by month. So the top of this is before COVID. So you could see a normal amount of inventory, 1.5 million homes or thereabouts. And we're on that sort of range right now. So while the inventory is a lot higher today than it was during the COVID boom, by no means is this amount of inventory abnormal. We're just getting close to what it has been historically in the past. It's just that we're not selling it as rapidly as we have in the past. So no surprise, marketing times are increasing because there's more inventory and not as many buyers. Prices have been leveling out. So this takes a look at the pricing by month, and you can see it's been a pretty steady march from 2017 at the bottom to 2024 at the top. The prices are going to be, I think, down a little bit in composite for this year, at least in Denver. And they'll probably be flat next year for Denver, and they'll probably go up at a very slow rate after that. If you were to take a look over the last 50 years in Denver, prices on average have gone up 6.5% a year. And I think your next 5 years, you're going to see it closer to 3. Still positive, just not aggressive.
Michael had a question. I think we kind of touched on this. Along the same lines, how long do we feel like the market will stay in a similar state that it is now, all across the board, not specific to the number of transactions? And I think you kind of just touched on that. We've got another 3-5 years of kind of sluggish appreciation. Would you agree with that?
From a slow appreciation standpoint, absolutely. I do think the transaction count will start to inch up a little bit, but it's going to be a while before we get back to the historical transaction volumes.
I agree.
Let's take a look here. So more homes are getting withdrawn after not finding a buyer. I think that's going to be more of a factor going forward. So for those of you who are realtors on the call, of the homes that withdraw in the fall and then get relisted in the spring, quite a few of those homes do actually go on to sell. The biggest catalyst that can help you out is that if you've had feedback from the buyer saying, I'm a first-time buyer. I can't afford to do any remodel work. I can't put in a new furnace and a new roof and paint carpet. I need all that stuff done for me, and I could pay a little bit more in my monthly payment, and I could pay more for the house. I just can't afford to buy the house as is and then write a check cash for all these things. If you find yourself in that situation, if you could take the home offline now and over the next 60 days, complete a lot of those renovations and relist it in the spring at a slightly higher price, your odds of getting that house sold in the spring are going to be a lot higher than they have been this fall. So take advantage of this 6-week, 8-week window where the buyer traffic is less to get your listings for next year positioned for success. Inventory, lots more price reductions. So what happens in a real estate downturn? So here's the last 4 big downturns that we had. In the early 1980s, we had really high inflation, and you can see that from the peak amount of sales to the bottom number of sales during that correction, home sales traffic dropped by 50%. And then in the next column, it took 4 years for us to dig out of that and get back to our former normal run rate. In 2008, we had the great foreclosure crisis. The number of home sales dropped by 51%. It took about 3 years to recover that time. In the early part of 2020, during COVID, you can see that the number of home sales dropped by 27%. But because the Federal Reserve slashed rates, mortgage rates went down quite a bit in this particular case, the time to recovery for the sales traffic was only 8 months. So this time around, we've seen the number of home sales drop by 39% compared to the peak. And how long will the recovery take? Well, we're about 3 years into this. I think 4 to 5 years, maybe 6 years. It's going to take a little longer than the prior ones. Will it take 10? No, that's probably not reasonable. It's not going to take that long for things to recover.
I agree.
Will the prices drop? So what we're finding is that if you compare the average home price to the average income, the average home costs about 5 times more than the average income. And historically, it's closer to 4 times. So, Joe, would you expect that as interest rates went up, that maybe this ratio would go down a little bit for affordability?
I would, yeah. Yeah, I think you're spot on. With income is just not kept up with appreciation, and income is not kept up with increases in taxes, insurance, HOAs, and it has not kept up with interest rate increases. So buyers that are investors or primary residence buyers, they're getting hit from all fronts. Prices are high, interest rates are high, taxes are high, insurance is high, HOA is high, my income is flat. That doesn't make for a great opportunity for first timers or primary residence buyers to buy what they want. I do still think it's important to buy, but you might have to buy something that's not as posh as you would have hoped for 2 or 3 or 4 years ago.
Kind of a challenge bundled in that is that groceries, gasoline, car insurance have all gone up a lot as well. And those are kind of like mandatory things you have to get. So the amount of money left over for savings for a down payment has been compressed. And meanwhile, we've got a larger percentage of, potential first-time buyers struggling with student loan debt. That's not going to go away. So there's just a lot of different headwinds. All this points to great news for the landlord long-term. Yep. There's going to be so many renters. So the average escrow amount for tax and insurance has increased by almost 50% in the last 6 years. It's pretty dramatic. So we have seen that Denver's had some very modestly declining prices on the order of about minus 3%. About half the cities in America are seeing a little bit in the way of price declines, and the other half a little bit in price increases. On average, it's just kind of flat. All right. So if you ask the economists, who are the experts, what's going to happen for home price appreciation in 2016, the guess is about a 1.7% appreciation. I think that's probably pretty good. I bet that's pretty close to what we're going to see next year.
I love this chart because it really highlights who's optimistic and hopeful, right? National Association of Realtors, very hopeful that we're going to get back to an appreciating market. All the way on the far right, Mortgage Bankers Association, everybody that does loans like me, they think the sky is falling because 6, 7, 8% interest rates are the devil. They think that homes are going to go down. So I love looking at who are the economists coming up with this. And I'd be right in the middle. Capital economics, 2%. I think I think that's a very solid estimate for the next 12 months.
Yeah, I mean, we still have a decent number of our cities in the U.S. that are seeing a modest amount of appreciation. So I think in composite, that's dead on. There'll be regional variations. I think Denver will be a little on the softer range for next year. Places like Cleveland and Chicago will do a little better. So there'll be some variation. So home equity has been skyrocketing over the last couple of years. So there's lots and lots of equity out there, which is great. Do you want to talk a little bit about this DTI? I think you already talked about it a bit. I don't know if there's anything additional you'd like to add on to it, Joe.
Yeah, this really just goes back to affordability. If you look on the right-hand side, January of 2021, interest rates were at record lows, 2% mortgages, 2.5%. That meant that the average home buyer was spending 13% of their income on their housing expenses. Now go over to the right-hand side. Today, 27% of the average home buyer spending 27% of their income on their housing expenses. That's doubled, right? And that goes back to the affordability challenge that we've spoken about. Is if I brought home, $10,000 5 years ago, and I could spend $1,300 on my house, yeah, it makes a ton of sense to buy a house. Now I bring home that same $10,000 because let's say my income has not gone up, and now I've got to spend $2,700 on the same house. Not as appealing to buy. So this just kind of pushes folks off the table, especially folks that are on the margins of barely able to qualify or barely able to save up that down payment or barely able to afford the payment. They may not have an opportunity to buy, which is unfortunate for the folks that are in that situation. But for investors on the call, may be fortunate because we're going to have more long-term renters.
Absolutely. There's always a silver lining. It's interesting if you take a look at the average house. It varies by state for the price. In Colorado, you need to have an income of $160,000 to buy the typical 3-bedroom house. Not a lot of families have that much cash. That's quite a lot of cash flow.
Yeah.
One of the highest ones on the list there. I was amazed to see Utah's even a little bit higher. Yeah, that's a real surprise. Okay. So as promised, what happens to real estate prices during a recession? So on the left-hand side, this is our last 6 recessions and what happened to national prices. So you can see that in 91, they went down a tiny amount. And in 2008, it was the crash due to a lot of real estate foreclosures that caused the recession. So no surprise, there was a huge correction there. Generally speaking, other than that, prices go up a little bit during a real estate recession. And then, Joe, what happens to rates during a recession?
Yeah, exiting a recession, you will often see interest rates come down. We've kind of seen that, right? If you were to go back 18 months ago, interest rates were almost 8%, and now interest rates are right around 6.2. So we've actually seen an improvement of as much as 1.8%, which I think is very positive. If we do truly go into a recession, a full recession, not a rolling recession, we might see interest rates get better by another 0.75% to 1%. But kind of as we touched on a number of slides ago, I don't think the odds are that great that we're actually going to have a recession.
I'd agree. So I expect to see like a modest improvement in mortgage rates over the next 6-12 months, but nothing dramatic. What would be reasonable, Joe? Like another 0.25 point?
Yeah. If we get to a rate of 5.9% and you've been thinking about buying a home, don't wait. If we get to a rate of 5.9%, you've been thinking about refinancing, don't wait.
Do it.
Yeah, just do it.
Yeah, get her locked in while you can.
Yep.
Is there going to be a foreclosure boom? The quick answer is no.
No.
So there's a record amount of equity out there right now, about $32 trillion of equity in all the homes versus only 12 or 13 trillion of debt. So lots and lots of equity. So if you take a look at during the housing crisis, this would be 2008 and 9, the average debt in America for mortgages was greater than the value of all the homes. There was no equity on average. Actually, on average, we were underwater. So there's no surprise there was lots of foreclosures. As opposed to this time around, you can see there's better than $20 trillion of equity. So very, very few people are underwater. So if someone gets sick or has some other sort of a hiccup, they just call one of the realtors on the call, sell the house, walk away with a couple $100,000 in equity, and get on to the next chapter of their lives.
Yep.
So Denver, about 4.2% of the homes are underwater, and the other 96% are in a good equity position. So Southern Florida looks like it's the toughest part to be in. Mortgage delinquencies, very, very low.
Very low.
We talked about our rates going to go up or down. So I think we covered all of that. How much did they go down this year? Like 0.7?
Yeah, I mean, at the beginning of the year, average rate was right around 6.97%. We're at 6.22 today. I've actually been helping a lot of my clients that bought within the last 12 to 24 months refinance down to, I mean, shoot, I had a couple closings today that were at 5.875. You know, they had to pay a little bit in discount points, but significantly saving people money that bought 2, 3, 4 years ago. So this has been very positive for the mortgage world and for folks that needed to refinance.
That's fantastic.
Mm-hmm.
So we've already seen a lot of rate drops. I wouldn't expect a whole ton more as a result of that.
I agree.
So rates, taking a look at the chart on the left, this is the number of people who are applying for a new mortgage, and that's usually a good leading indicator of people deciding to put something under contract. On the right-hand side, when someone finds the house that they want, they get it under contract, they would probably call Joe up the next morning and say, hey, I found the house, let's lock in our rate. So you can see that there's been an uptick in the number of mortgage applications, and the number of rate locks has been kind of steady here for a while. Is that kind of similar to what you're seeing, Joe?
Yeah, I want to add a little bit to this too. If you think back to the spring, and there was a lot of articles in the Denver Post and the Wall Street Journal that the spring selling season is here, but it's not that exciting. Maybe we're going to get some more seasonality in the summer. If you look at that brown line on the right-hand side, you see it's been flat. There was no spring or summer selling season this year. It was very methodical with roughly the same number of sales every single month. And interestingly, has not really trailed off as we're approaching the end of the year. Now, you know, in 2 months when we do this, we might see that trail off for Thanksgiving and December, but maybe not. It might just be kind of a stagnant, non-seasonal year, which is a very odd thing to see. You know, if you look back at some of the prior years, we see those spikes in like week 19, which is kind of April. You see those spikes right around the middle of the year for the summer selling season. We did not experience that this year.
No, it's been a very unusual and slow year all the way across the board, which has been a little frustrating if you're a seller, but a great opportunity if you're a buyer. It looks like your refi activity has been a little bit better this year than last year, huh?
It has, yeah. If you look at that blue line at the bottom there where it says 2025, you see the it's not a spike, but the increase over the last 8 weeks as rates have gotten below 6.4%. That was kind of not a magic number, but a breaking point that it started to make sense for a lot of people to refinance once rates came below 6.4%. A lot of people had a rate from 2 years ago of 7.5%. Now they can save 0.75% to 1%. Refinance activity has gone up, and we're experiencing that still today.
It's fantastic. I love this. In 1971, the rate was 7.3%, not that dissimilar to what it was this spring. If you said, I'm going to wait for rates to go down, you would have waited for 22 years for rates to go down. But the value of real estate in that time quadrupled. So, you know, if it makes sense for your lifestyle and you can afford it, buy the house. Don't wait on rates. You can always refinance it later. And refinancing is not that difficult, is it, Joe?
No, it's very easy. You know, 2.5, 3 weeks, paycheck stubs, bank statements, W-2s, get the property appraised, make sure you still have equity in it. Very, very simple process.
Yeah, nothing to it. So in a nutshell, the impact of increasing rates is that the market number of transactions slows down a lot. So we've talked about that quite a bit. What's next for rentals? What I want to talk about here is underbuilding. So in composite across America, we've been underbuilding relative to the population. And if you take a look on the left-hand side, you can see the number of units that we've added per 1,000 people is the lowest of all these large industrialized countries. So we've got a supply imbalance where we have a couple million fewer housing units than what we really should have given our population. And it's roughly divided between for sale product and for rent products. Both of them have a deficiency. So what's going on with apartments? Well, we can see on the orange line here is that apartment prices peaked in late 21, early 22. They've dropped about 20% off the peak, and they've been flat for just about a year. You can't call a bottom until significantly after the fact. But I will bet any of you guys a cup of coffee that we have seen the bottom of prices on apartments and that they're going to gradually pull out from here on out. Similarly, you can see in some of the other categories like office and retail that we're probably past the bottom as well. So most of the corrections that we're going to see in commercial real estate are behind us at this point.
Yep.
So absorption means that you had a prior vacant apartment unit that you filled during the quarter with a paying tenant. So you can see that the amount of absorption or new tenants getting added to the market has been at record levels over the last couple of quarters. And that's been really fantastic for demand. If you look on the supply side, there was a lot of new apartment complexes that got started in 21 and 22, the first part, when the rates were super cheap and the lenders were very much in the mood to make new loans. And you can see that all those projects that started in 2021 got delivered in 2024. It takes about 3 years for the entire life cycle to design, build, and then populate a new apartment building. So you can see the expected amount of supply in 25 is quite a lot less than what was delivered in 24, and that the new deliveries in 26 will be about half of what we had in 24. So we've got a very good prediction of what the new supply deliveries will look like for the next 3 years, because if you're breaking ground on a new apartment complex today, I'm not going to see that capacity hit the market till late 29 or late 28 or early 29, most likely. So the main message from this is that the supply of new apartments is falling dramatically. And for this whole presentation, we've talked about all the headwinds preventing a first-time buyer from becoming a buyer, which means they're all going to be renters longer. So when you take a look at this last couple of years where we've had all of this massive absorption, that's because people can't afford to buy. They don't have a choice. They have to rent longer. And that's great. We've had all these new apartments get delivered, and we've filled them all up with these people who are not buying.
Yep.
So the amount of units under construction has fallen a lot, as we've discussed. It's very difficult to raise the capital to fund a new build, and the banks are not too excited about giving loans for construction, and the rates, of course, are not very affordable either. So what this means is that there's going to be a supply-demand imbalance where there's going to be more demand on the part of renters for the next 3 to 5 years than there's going to be supply being added. So that means for anybody who is a landlord now, they're going to have more and more renters competing for those empty units. So that means the vacancy rate will go down, concessions will go down, and that means that rents will start to go up, which will improve the cash flow for all of us who are landlords. So it's a fantastic time to be buying rental properties. And I think somebody earlier on the call was asking about, should I do that? And the answer is, if you find a good one, yes, you should do that.
I agree. Yep, you should.
So one of the things that we've seen recently is that landlords are working really hard to retain the residents that they've got. Stupidly, in the past, you might give 8 weeks free rent plus a gift card on Amazon to get someone new in the building. But when that lease was up, they wouldn't give anything special to retain it. And then they'd be shocked when that person moved across the street and got another unit with 8 weeks free. So now they're telling the tenant, like, look, we don't want you to go across the street. We'll give you 6 weeks free if you renew. And as a result, people aren't moving as much. So it's really helped retain people within the buildings, which improves the economics pretty dramatically.
Yeah, vacancy is the enemy, as I've learned from Eric Ross. Keep
Oh
your
my gosh.
units filled.
No doubt.
Don't if somebody asks for a $50 concession, they want $50 off to renew for another year, take it. Don't
absolutely
get greedy in the current market with your vacancy. And we do have a question here, Lon. Should this not be a strong case for single family rentals? Not everyone wants to live in an apartment building.
If you can find a single family that'll cash flow, I would agree you should buy it because there's a shortage of that type of inventory. Me personally, I'm getting closer to retirement, so I'm trying to sell my active rentals and push more of my funds into passive investing. So when I'm selling off my current rentals, usually it's an owner occupant that buys them from me. So the rental
Mhm.
pool of condos and homes is shrinking as people like me get rid of our rentals. So yes, there's a very enthusiastic audience for condos to a lesser extent, townhomes better, but homes in particular, there's a lot of demand. So yes, absolutely.
I agree.
Please type in more questions. We've got like 10 minutes or so left here. I'll just wind this down. A lot of people ask, well, that's great, Lon. We've had all this great demand on the part of renters recently. Is that likely to continue? So this chart shows you the demographics, and demographics is destiny. So over the last 40 years, we would typically expect somewhere around 12 to 16% of kids, young adults, between the ages of 25 and 34 to be living with their parents. And you can see that for the last several years, the number of young adults still living at home has been at the very high end of the range. So it's come down a teeny bit from 2019 and 2020, but it's still like way higher than it should be. So if we got the number of young adults living at home from 16.5% down to say 14, which would be about the average of the last 40 years, that would be 940,000 new renters.
Mhm.
So while there's a lot of capacity that's been taken, there's still a lot of young adults on the sideline that would love to get out of their parents' house. So there's plenty more rental demand all set to go. It's just a question when they're going to go do it.
Yep.
So I'm going to pause there and let's see what additional questions we can answer for people.
I think we've hit everything, but if you guys have more questions, please type them in. We've got a handful of minutes still remaining. Our favorite part is talking about the questions that you guys have. So let us know what you think. If you disagree with Lon or myself, those are usually my favorite conversations. So
Absolutely.
put that in. If you think we're wrong, we would love to hear what you guys think. Lon, there was one slide. Can you go back to the presentation for a moment? Go back just a couple of slides, if you would.
You bet.
A couple more. One more. Forward one. One more. I just want to touch on exactly what you said here on the absorption being an absolute record. So all of those people that are above the blue line on the far right-hand side, those are the folks that generally would have been buying a home. So when we talked about affordability and student loan debt, taxes are up, insurance is up, hard to save for a down payment. These are the folks that are really in graphical format. We're seeing those folks that generally would have bought a home are now becoming renters. So you take those people that are having to move into rental properties rather than buy. I think it's a very, very good sign for landlords, whether it is having an apartment complex that you invest in, or if it would be buying an individual condo or an individual single family home. There's a lot of folks that are having to rent because they just simply cannot buy. So I think this chart really represents everything that we looked at on the affordability charts a while back. Now, Kim
That's
had a
excellent.
question here, Lon. The Denver Post said this morning that long-term slowdown in migration into Colorado is due to the cost of living. Do we have any comments on this and how that might impact home prices? What a great question.
I think it's absolutely true. So part of that is a multifactorial thing. So part of our growth in population has been international. And that's really been slowed down a lot with all the initiatives of the current administration. So with less inbound immigrants, there's less housing demand. Also, from just current citizens moving in from other states, for a lot of decades, Denver benefited from the fact that we created a lot of jobs here, and people would move from other states, like I moved here from Florida, and it created a lot of demand for housing from all these extra new people that were coming in. That's slowed down a lot because Denver doesn't have a price advantage. Denver's actually the most expensive city for housing that's not on a coast. And that makes it really challenging when our competitor cities like Salt Lake or Austin or Atlanta You can go to those cities instead of Denver and get a house for significantly less. Or like my daughter found in Houston, like the homes are half price of what they cost here. So Houston's still growing and we're not. A final factor is that for a lot of years, we had a slightly younger than average population in Denver, with a larger percentage of our population in the prime childbearing years. So our natural birth rate versus death rate was very favorable. We're like just generating lots and lots of kids. As the inbound rate of people moving in slowed down, the average age in Denver is aging, just like the rest of the country. And we have fewer people in childbearing age, but the number of deaths is increasing. So what used to be a population driver for more births than deaths, that's also equalized. So if you look at the three main levers that impact population growth, all of them have swung in Denver from being favorable to neutral or negative. So with less population growth, it's difficult to drive really robust increases in pricing. So it's one more factor that's a headwind unique to Denver, not for the rest of the country, on why prices will be relatively flat going forward. Kind of a long answer to a short question, but
yeah, very smart. Any other final questions, guys? We've got 3 minutes left. But outside of that, Lon, let me ask you, with investing in apartments, this is something that Ironton does, right? If I don't have the capability to go out and buy my own, 25 unit apartment complex that's going to cost me $3 million, is there a way that I can do fractional investing with you and your folks there at Ironton?
yes. So our long-term fund, where you're tied up for about 5 years, we either are building new apartment complexes or we're doing a heavy renovation of an existing complex. We can raise the rents pretty dramatically. That's about 2/3 to say 70% of what we do, and the rest will be hospitality or warehouses. And our goal is to get a basket of about 30 different commercial properties, 10 or 12 different states. So really broad diversification. So you could write a check for $50, $100, $250,000 and get access to a huge portfolio, not dissimilar to buying a mutual fund of stocks. So yeah, we've got a great tool. Thank you so much for asking about that.
Yeah, absolutely. And I'm going to put my contact information into the chat. My job, I'm with Synergy One Lending, and I provide financing for your primary residence, for your investment properties, your second home. Work with a lot of investors that join us on these calls, and they say, you know what, I've got $200,000, $300,000, $400,000 tied up in dead equity in my investment property. Myself and Nick Elder at Ironton Capital, we're happy to review that equity with you, see if it might make sense to take some cash out of that property, either in the form of a second mortgage or refinance, and look at other ways to deploy that capital. So that's a big reason that I like to join these, is there might be ways that we can help you earn additional money without having to sell something. So hopefully this was valuable for you guys. And Lon, any final thoughts?
I think that's it. Thanks for joining us tonight, everybody. And John asked about when you do your analysis of rental cash flow compared to selling, depending on if you depreciate the property, is the tax issue mitigated by 1031s? Yeah. So John, what you can do is reach out to us, and I can help you do the analysis for any of you guys. If you've got a rental, if you were to sell it, we could factor in all the tax implications if you did a 1031 exchange or not. And if you don't do a 1031, we can show you a bunch of different investing options. And in some cases, even though you have to pay some tax, you might still come out way ahead over a 10-year period. But I'd be delighted to do that. I do that several times a week for investors. Great question.
Outstanding. Great final question there, John. Thank you. And if there's
Thanks,
anything else we
everybody.
can do, let us know.